I have 2 more years to be eligible for Medicare. Does it make sense to spend money out of a Roth account older than 5 years after depleting cash so as to reduce MAGI to maximize ACA subsidies? You may also want to talk about those acronyms just to make sure everyone is on the same page.
Yeah. So we've got someone 2 years before Medicare eligibility. And for most people, that would imply they're 63 years old, becoming eligible for Medicare at 65. And they're using the Affordable Care Act for health insurance until Medicare eligibility starts. So in those 2 years, you actually get the double whammy of the impacts of taxable income, your modified adjusted gross income used to calculate either your Affordable Care Act subsidies or your Medicare premiums. The income you have at ages 63 and 64 could both reduce your Affordable Care Act subsidies as well as lead to IRMAA surcharges, because that income, you look at that income 2 years later to determine your Medicare premiums for the year. So yeah, I mean, we got to look at a case-by-case basis. And so this is only a general kind of conversation. But indeed, it does make sense to consider whether it's worthwhile to potentially tap into the Roth to meet expenses at ages 73 and 74, assuming you can take those qualified distributions, to help manage Medicare surcharges 2 years later, as well as to manage how much Affordable Care Act subsidies you're eligible for this year. The Affordable Care Act subsidy imply the loss of subsidies, if you frame that as a tax. I mean, it's not a tax, but it's if I earn another dollar of income, I get less subsidies. It works in the same manner as a tax, and the effective marginal tax rate on that, up until you get to the 400% level threshold of the poverty line, which could be somewhere depending on where you live and how many people in your household, up in somewhere in the ballpark of $80,000. Below that point, the implied marginal tax, it jumps around quite a bit. So, but it's fluctuating between about 6% and 18.5%. But for a lot of those income levels, it's closer to that 18.5% side. And then once you get past 400% of the poverty line, you get a long tail where the effective marginal tax rate is 8.5%. And that gets added on all your other tax brackets and tax rates. So you don't necessarily want to be voluntarily generating taxable income when you're eligible for Affordable Care Act subsidies. And also now, by the time IRMAA becomes an issue, you're probably in that long tail of the 8.5% on the Affordable Care Act. And you're watching out for those Medicare surcharges 2 years later. Yeah, I can't say with certainty that you should spend from your Roth in those years, but I certainly think the case is there to investigate whether that's a worthwhile consideration to help manage your modified adjusted gross income in those years where you're impacting both Affordable Care Act subsidies and Medicare surcharges for 2 years later.